Hello everybody and welcome to today's webinar. My name's Lisa Gissing and I'll be your presenter for the next 30 minutes or so. And I'm very pleased to have with us today Brian Ashton, who's the head of Financial Literacy and Advocacy within the advice business at BT Financial Group, leading a team of professionals committed to supporting the advisor community with technical, regulatory, policy and research support. Brian has many years' experience in leading and delivering comprehensive technical solutions to advisors and their clients, the last 15 spent with the BT Financial Group. With qualifications in law, commerce and financial planning, and also being a SMSF Association Specialist Advisor, Brian is a frequent presenter and facilitator at many industry events and regularly contributes to trade and consumer publications. So a very warm welcome to you, Brian.
Thank you.
So before we get into today's session, I've just got a couple of housekeeping rules that we just need to run through, just to make sure that everybody's got the opportunity to hear and get the most out of Brian's presentation today. So, with so many people joining us today, it can get a little bit noisy in the background, so we've placed you all into listen-only mode. As this, however, is a live webinar, you can ask questions. So please type your questions into the questions panel, either on the right-hand side if you're joining us today on a desktop computer, or you might find a question mark at either the bottom or the top of the screen if you're joining us today on a mobile device. I'd also suggest too that you type them in when you think of them, and Brian will come back at the end of the presentation to answer any of those questions for you. And also too, if you've got any other suggestions for any other topics that you'd be interested in hearing about from the Davidson Institute, please share them with us also in that questions panel as well. And finally, this is being recorded today, so you'll receive an email later on with the link to a recorded version of this webinar, where you'll also be able to download a summary. So, Brian, let's get into it. The latest super changes impacts for SMSFs, all yours.
Thank you, Lisa, and hello, everybody. Over the course of the next 30 minutes, what I'd like to do is take you through an overview of the changes that were first announced in last year's federal budget and has since been legislated, but largely take effect in relation to superannuation from the 1st of July 2017. Now, this session, as we're going through, I think what's really important to understand is that none of what I'm going to talk about is actually personal advice. Everybody's circumstances are different. So my strongest recommendation to you initially is please don't take action based on what we talk about in just this 30-minute overview. These changes are quite complex, and I would recommend that anybody who has a concern or a question about how these rules might impact on them actually seek some personal advice as to what does it actually mean for you in your particular scenario. But if we look at these superannuation changes, the level of complexity probably doesn't surprise me when in terms of how many people just ask questions and the level of confusion. And I guess if we try and look at a bit of a roadmap of where we started off and where we have got to around this, it just shows you how complicated and how many twists and turns we have actually had. I mean, it was back in May last year that the federal budget was announced and the government talked about all of these changes to superannuation. And then just a few days later, they called a federal election. And so, of course, we didn't know whether anything was going to get passed and who would come back in again. We then got through to July with the election, and ultimately the coalition was returned to government. Then on the 7th of September, the government released its first tranche of draft legislation to give effect to these changes. It was just a draft for comment. Just over a week later, they then announced some changes to what they'd originally talked about on budget night, and then we got a second and a third draft of legislation coming through. Finally, the legislation was introduced into Parliament on the 9th of November, and it was passed by the 29th of November. So the one thing to say is, as much as it's been confusing as to where we get to today, we do now have a final set of legislation that is in place that will give effect to changes from the 1st of July 2017. So what I want to do is take you through three broad categories of changes. The first two both relate to contributions, and we'll talk about what are the rules for this year, but also what changes from the 1st of July to give you an idea of the things that you should be thinking about in terms of potential action that you might be able to take. And then the third one that we'll talk about is what changes from a superannuation pension perspective from the 1st of July, because that is perhaps the biggest impact for a lot of superannuation members, and particularly for self-managed superannuation fund members. So let's start off by looking at concessional contributions. So in a really broad sense, when we talk about concessional contributions, we're talking about the types of contributions that somebody can claim a tax deduction for. And generally, this encompasses three types. There are super guarantee payments that can come through from an employer. There are salary sacrifice contributions where you may choose to forego some salary and have your employer redirect that into a superannuation fund on your behalf. And the third one is if you are self-employed, you may be eligible to claim a personal tax deduction for contributions going into super. So collectively, we refer to those as concessional contributions. Now, what's changing in this space? Well, if we look at it for this financial year, essentially there are no changes to the rules. So the maximum amount of concessional contributions you can have going into superannuation this year depends on your age. So if you are 50 and above, the limit for this year is $35,000. If you're below the age of 50, it's a $30,000 limit. Remembering that those limits are across those three types of contributions added together. It's not 30 or 35,000 for each type of contribution. This is where things, though, start to change from the 1st of July. From the 1st of July, the maximum limit will fall to $25,000, and that applies for everybody. So it doesn't matter based on your age whether you're over 50 or under 50, it falls down to $50,000. So clearly the first thing that you should be thinking about right now is if you have that $30,000 or $35,000 limit, how close to that can you get for this financial year before it drops down to $25,000? And what are the ways that you can do it? The second change that comes in from the 1st of July 2017 is that we have better deductibility rules. And what I mean by this is the ability for somebody to claim a tax deduction for a personal contribution to super will be opened up, which essentially means if you are eligible to contribute, you could claim a tax deduction for that contribution. Still subject to this new $25,000 limit in total, but anyone can claim it. It's not just for self-employed people. So as an example, what that potentially means is for people who are receiving a salary, you might still salary sacrifice throughout the year, but if in the past you've received a bonus and there's been a question about whether you can salary sacrifice that bonus into the super environment to get you a better outcome, that is a new opportunity that potentially is opened up. Again, there are rules around these things, so don't just assume we can go and do it straight off, but it is an opportunity that opens up. Some people are also members of other types of superannuation schemes, which we're referring to here as an untaxed super scheme. And generally, these are government-funded schemes. They have a separate set of rules where you can contribute to those with concessional contributions above the current $30,000 or $35,000 or in the future to the $25,000 limit, and you can still go in excess of that limit in those funds, but it will restrict the level of concessional contributions you can make to your own self-managed superannuation fund. So there are some constraints that are coming in, but still some opportunities that exist in that space. Now, these schemes are fairly limited and often they're closed to any new members, so it's really only an issue to be aware of if you are already a member of that sort of super scheme. And then the next point, as we've got on the slide here, is there's a Division 293 tax which will apply from $250,000. Now, this Division 293 tax exists today, and essentially it says in today's environment, if you have a total income of $300,000 or more, in addition to the standard 15% tax that is paid on your concessional contributions when they go into the fund, there is an additional 15% tax that would be paid. So a total of 30% on those contributions up to that $30,000 or $35,000 limit. So as I said, today that cuts in at a level of $300,000 of total income. From the 1st of July, it will actually cut in for people earning above $250,000. So more people will be caught by it, but that extra 15% tax only applies on your concessional contributions up to that cap. So it'll be up to the $25,000 that you have the extra 15% tax payable on. The other change that was announced that doesn't start until the 1st of July 2018 is actually a new ability to carry forward any unused concessional contributions for up to 5 years. And in essence what this says is if in the year starting 1 July 2018 you only have concessional contributions of $15,000, so you're $10,000 below your cap. That $10,000 unused amount can be carried forward for up to 5 years. So in a future year, you could potentially, under these numbers, do a $35,000 concessional contribution. So that hasn't existed in the past. If you didn't use it, you lost it. Now you can carry it forward. The only constraint is that in the year that you want to use that carry forward amount, you must have less than $500,000 worth of total super. So again, there are qualifications that you need to be aware of in the year that you want to use that unused amount. But in essence, for concessional contributions, clearly the things to be thinking about right now are we targeting the maximum amount that we can do? It is a limit of $35,000 or $30,000, but clearly the first issue is how much can you afford to do, not how do we just get to that number straight off. The second type of contribution to look at is non-concessional contributions. And in essence, this is all other types of contributions, or ones where there's already been tax paid on it. And the simplest example of this is where you choose to make a voluntary contribution into superannuation of your after-tax money. So for example, you take some money out of your bank account and you choose to put it into the superannuation system. Now, into the future, there are certain criteria that will apply in order to make non-concessional contributions. Two of those essentially apply today, and one of them is a new requirement. So the first one is that you must meet the eligibility requirements to actually contribute to super. And I'll come back to that in a moment about what are those eligibility requirements. The second one, which is really the third point here on the slide, is to say if you are eligible to contribute, the maximum amount you can contribute on the annual basis will now be $100,000. Currently, it's $180,000, so it's going to drop down to a new limit of $100,000 per annum. Then the third requirement, which is a new requirement, is that you can only make this non-concessional contribution, assuming you meet the other rules, if your total super at the previous 30 June was below $1.6 million. So if these rules kick in from the 1st of July 2017, in order to make a non-concessional contribution during the 2017/18 financial year, you must have had less than $1.6 million in the super system at 30 June 2017. So that being the immediately preceding 30 June. So if you meet those requirements, you can continue to make non-concessional contributions. So the question therefore comes up probably, what does it actually mean for this year? If those rules are changing, what can we do this year? Now, to a large extent, the rules for this year are unchanged. So the first one comes around eligibility rules. The first eligibility rule is based on your age, and it is your age at the time of the contribution. If you are under 65 at the time that you wish to contribute, you are eligible to do it. If you are age 75 or above, you're not eligible to put any more money into the superannuation system. If you are between 65 and 74, there is a new requirement, or there's an additional requirement that you need to satisfy, and that's a work test. And the work test says, have you worked for 40 hours within a 30-day period during the financial year? So you don't need to be working at the time of the contribution. As long as you have met that test for the year, you'll be able to make it. So as an example, if you were aged 67 and you worked full-time for the first week of July and did 40 hours worth of work in that week, then you can contribute at any time through to the following 30 June because you've satisfied the work test. So they're the main eligibility requirements. The next thing, though, that we have to look at in terms of how much can you contribute this year is essentially looking at your contribution history. So if you like, it's a bit like looking at a credit report and what have we been doing in the past. And the real question here is how much have you contributed in the last 2 years? Because that will determine the answer as to how much you can do this year, and the answer will be somewhere between $0 and $540,000. And this answer will be different for everybody. So to give you an example, assuming that we are eligible to contribute, how might the answer be $540,000? Well, we have these provisions under superannuation law called a bring forward or an averaging provision that under today's legislation says if you are under 65 at the start of the financial year, so in this case we're saying at 1 July 2016, if you are under 65, then you have the ability to contribute not only this year's annual amount, which is $180,000, but you can actually do up to 3 times that amount. So 3 times $180,000 gets you to the $540,000. And if you do that, you can contribute up to that amount this year, but it places a limit on what you can do in the next 2 financial years. So if you could do $540,000 this year, you can't make any non-concessional contributions for the next 2 financial years. If you had applied this rule 2 years ago and put in $540,000 2 years ago under the rules as they stood, then that would limit your ability to contribute this year to actually a figure of 0. And so that's where we get, it could be 0, it could be $540,000, or it could be somewhere in between. So again, it's really important to look back and say, how much have you contributed in the last 2 years? And has this bring forward rule been invoked? And it is invoked if you put more than $180,000 in a particular financial year. That bring forward rule will still apply from the 1st of July next year, but it'll be 3 times the new limit. So it'll be 3 times 100,000 or 300,000 over a 3-year period. So again, there is still the ability to get money into super this year, and it's really important to think about it because that requirement to have less than $1.6 million doesn't apply this financial year. That only starts from the 1st of July next year. But again, it's also important to understand how much have you contributed in the past, what's the maximum number that you're allowed to do this year, and then it comes back to how much can you actually afford to do. And that's really the essential question, because you don't want to do more than you're willing to lock away for that future period of time. To a large extent, that's it about the contribution side. What I'll now do is move across to the pension changes themselves. And I want to start off by trying to give you the very high-level summary as to what it means. And then we'll talk a little bit about some of the detail. So the pension changes themselves in a nutshell. The first one is from a personal tax viewpoint. If we put aside whether you're receiving a defined benefit pension or not, there is no change to your own personal tax situation from these superannuation rules. So again, ignoring defined benefit pensions, if you are in a pension today, a standard account-based pension or an allocated pension as they're often referred to, and you're over the age of 60, today you receive those pension payments tax-free. From the 1st of July 2017 going forward, you will continue to receive those payments tax-free. If you're over the age of 60 and you're taking money from the accumulation side of super, you're eligible to do that, you will receive it tax-free. From the 1st of July 2017, you'll continue to receive it tax-free. The only change from a personal tax perspective is if you are in receipt of defined benefit pension income and the amount that you receive in the financial year is greater than $100,000 from that defined benefit pension. If you're in that scenario, there will be some additional tax to pay, but it will depend on how much above $100,000 it is and the type of fund that it's coming from. And I recommend you get some tax advice just to understand how that would apply if you're in that sort of scenario. The second change that was announced is essentially that if you're running a transition to retirement income stream, so this is an income stream that you can start once you reach your preservation age, which historically was 55, but has been gradually increasing through to age 60. But it's an ability to start an income stream from super without the need to retire. And a transition to retirement income stream says you can take 4 to 10% of your account balance out each year as a pension payment, but you can't take out any lump sum, so no more than 10% in any given year. Under today's rules, if you start a transition to retirement income stream, to the extent your super is invested to support the payment of that pension, the earnings on the underlying assets within your superannuation fund are tax-free. Same as the payments you would receive over the age of 60 are also tax-free to you. From the 1st of July, that tax-free treatment inside the superannuation fund will be lost. So it's as if these monies are sitting still in an accumulation phase and they're taxed at the standard superannuation rate of 15%. If you're in a retirement phase pension, which is really any other form of pension that you'd just be drawing down normal retirement, if you have less than $1.6 million sitting inside total super in that pension account, there is no impact for you. If you have more than $1.6 million inside super, then the maximum you can transfer into a pension will be $1.6 million, and anything above that must stay in the accumulation phase. Or if you are already running a pension worth more than $1.6 million, from the 1st of July, any amount above that $1.6 million level will need to move back to the accumulation phase. And then when it's in the accumulation phase, it gets taxed at a maximum of 15%. So in summary, if you look at these pension changes and what do they really mean? The end impact is that you may end up paying up to 15% more tax on some of the earnings within your superannuation fund. And really, as complicated as the rules actually are in terms of implementation and how they work, in essence, that's what the impact is for you. You may pay up to 15% tax. For many people, the answer will be they don't, because if you don't have more than $1.6 million inside super, and you're not running a transitional retirement income stream, and you're just running normal superannuation pensions, there are essentially no changes to you out of these rules. Now, I want to go into some things in a little bit more detail for you as to what does it actually mean for you and your super, because there are some additional things to be aware of, and again, some things to think about in terms of what do we do. So some of the things to be thinking about, the first one is if you do have a transition to retirement pension in place. As we said, from the 1st of July, that moves from being tax exempt within super to being in a 15% tax environment. So the question has to go back to, would you look to continue to run that pension? Because you can always stop it and have the money sitting in accumulation phase, and it will get taxed exactly the same way. So it's only really a question of, do you need the additional income that comes out of this transitional retirement pension? Because if you do, then it may still be worth continuing it going forward. And just knowing you've got a little bit of extra tax to pay within the fund, because there's no change again to your personal tax outcomes from it. So why did you commence it in the beginning? And do those reasons still remain valid? And so should we continue it from the 1st of July or not? If you choose to move and essentially stop that pension by 30 June this year, then you may also be able to obtain some CGT relief. And I will talk about that one in a little bit of detail in a moment. So we'll just park that question or that issue for the moment. If you're looking at a normal retirement pension and you have in excess of $1.6 million already in pension, then from the 1st of July, you'll be required to reduce your pension down to $1.6 million. It's a new concept called a transfer balance cap amount. And so that places this $1.6 million limit. And you can, again, choose to do that prior to the 1st of July if you want to and obtain some CGT relief. Again, we'll come back to it. But if you don't have more than $1.6 million sitting inside a pension, you don't need to take any action as a result of these changes. And I think that's important to understand. You don't have to take action, and there won't be any other consequences for you. It's essentially continuing as it is today. So what is this CGT relief? What the government has said is essentially if you take positive steps to structure your pensions to comply with the rules as they will be from the 1st of July 2017, and you do it before then, so essentially you do it by 30 June 2017, they will give you some CGT relief. Now, it sounds nice for the government to be giving you some CGT relief, and you might wonder why would they do it. Part of it is if they don't then have to write out to everyone to try and restructure it, it reduces the impact for them, so therefore they're giving you a benefit back. But also, it's a case of saying you could almost get to a similar outcome by selling assets and then getting the cash and going purchasing something else. So they're giving some relief saying, well, if you don't need to sell the asset, then there's potentially some relief we can give you to avoid those unnecessary transaction costs and time that's involved in doing it. So the requirements broadly are, in order to get this relief, is it only applies to the extent that you had assets in your fund that were supporting a pension as at the 9th of November 2016. So really you needed to be in pension phase at that time. Or assets had to be owned by the fund at that particular point in time. And it only applies to the extent necessary to bring you in line with the new legislation. So to give you a simple example, if you were in a fortunate position to have a pension of, let's say, $2 million today, and the new rules say you can only have $1.6 million in the pension, so there's $400,000 excess that you need to deal to. If you move that $400,000 of excess from your pension phase back to the accumulation phase, and therefore you're moving the underlying assets to support that $400,000 across, you'll get this CGT relief, which I'll talk about what it is in a moment, but you'll get this CGT relief. But if you try to move more than $400,000 across in the hope of getting CGT relief on a greater amount, the tax office is likely to say, no, you can't do that, and it is limited only to the $400,000. So again, it's a tax issue, and I would recommend you get tax advice before you start making all of these changes to make sure you do it appropriately and in accordance with the rules. Now, the benefit that you get if you choose to do this on a voluntary basis by 30 June is that you can reset the cost base of those underlying assets. And you'll only have to pay capital gains on any future growth on those assets. So just to give you a simple example, if you owned an asset within your superannuation fund that you purchased for $100, however long ago it was you purchased it for $100, and today that asset is worth $400. Now, in a normal environment, if you sold that asset today for $400, you'll have a $300 capital gain, and you'll need to work out the tax liability on that. What these rules will do is to say we can reset the cost base of that asset from $100 to $400, and then if we sell the asset in the future at $500, we're only paying capital gains tax on that $100 worth of growth. So there's a real benefit in getting that uplift. But you only get it if you choose to take this relief and you choose to do it by the 30th of June. If you don't take the appropriate action before then and the government writes or the ATO writes to you and says you need to fix it up, you don't get that step up in the cost base. And so when you sell that asset in the example I just used, you'll actually have a capital gain based on a future sale value of $500 less the original $100 you paid for it. So we're paying tax on a $400 gain. So it's worth looking at it. Now, the choice to do this is actually made on an asset-by-asset basis, so you don't have to do it for every asset. And you may not want to because you may have some assets that have actually fallen in value that have a capital loss. So you want to make sure that you have the ability to retain that loss into the future. So it's an asset-by-asset choice. And the choice will need to be made by the time that your self-managed super fund is due to lodge its tax return for the year ended 30 June 2017. So it's for this financial year that we're in. So again, there are requirements, there are additional layers of complexity in there depending on how your fund operates, but broadly there is some relief that is available. So it's worth again considering and seeking some advice as to how could you actually go about doing that. And then the last piece I just wanted to finish off on before we open up potentially to any questions is what are some of the other things that you need to be thinking about. So one of these is if you're in a self-managed superannuation fund, that has previously borrowed to purchase an asset. So often it might be that a self-managed super fund has borrowed to purchase a property. And as part of the lending arrangements, the lender has taken into account the level of contributions that you will be making into the future. You need to reassess against the new contribution limits. Can you still make those contributions? So, you know, can the loan still stay in place and you can continue to fund it on the interest and principal repayments? Or will it be necessary to think about, are there any other options, or do we need to sell the asset and close down the loan? So again, there's considerations in that scenario. It'll also be important to think about if you have pensions in place today, are they reversionary or not? And by reversionary, we mean if you have a pension today and you were to pass away, does it automatically pass across and continue to pay to a spouse, for example? Or does it become a decision for the trustee to work out where any remaining superannuation is paid to? Because there are impacts out of these new rules about what actually happens upon death and how amounts are assessed. Because what could happen now is money that in the past could have stayed within the superannuation system and transferred across to your spouse upon death may be required to exit the superannuation system. And it is a may because, again, it's going to depend on your relevant balance at the time of death, and it will depend on your spouse's balance in terms of how much they can receive and how they can receive it. So again, it's important to start thinking about what could that look like, even though that may be many, many years into the future, just to have an understanding to ensure any estate planning issues are dealt to today, and so we've got clearer guidelines for the people who remain behind as to what your wishes are. The next point that we have on the slide here is about, can a fund continue to operate on a segregated basis? And this again is a very complicated area, and it requires you to talk with an advisor and the administrator of your fund as to how does this actually operate. But a segregated basis today essentially says that we pick which assets support pensions and we pick which assets are supporting the accumulation accounts inside the fund. From the 1st of July, for many self-managed superannuation funds, the ability to make that choice and to allocate assets to specific parts of the fund may disappear. And it disappears if certain criteria are met, which broadly say, was there somebody who was a member of the fund at some point in the year who had more than $1.6 million within the superannuation system, wherever that may be, and was also in receipt of a pension, wherever that may be. If those criteria are satisfied, then your self-managed super fund can no longer operate on a segregated asset basis. Now, this may not have a significant impact, or it may. That'll depend on the underlying assets. It will depend on the relative account balances in terms of how much is in accumulation, how much is in pension. But again, it is a potential change that could be forced upon you because of this legislative change. So out of all of that, I think there are a number of things to be thinking about for this year and also for next year. So in terms of those tax deductible or concessional contributions and your after-tax or non-concessional contributions, it's thinking about how much can you actually make this year. Are you maximising to the extent that the limits will allow, but more importantly to the amount that you can afford to put into the superannuation system? Because again, one thing always to remember is don't overcommit yourself. Money that you contribute to the superannuation system is locked away until you meet a certain condition to have access to it again. So you've got to be willing to give it up. But that's why you get the benefit of the lower tax environment within super. And then once that money is in the system, how do you invest it? What do you do with those contributions? And if you're looking at your pension side of things, particularly if you are running a pension already, do you actually have an immediate impact? So do you have more than $1.6 million in a super system, so you need to restructure some of those pensions? Should you look to do that before the 30th of June? Do you want to try and get some of this CGT relief? And if so, in relation to which assets? And then how do you look again to invest your assets into the future to make sure that your pension can last as long as it possibly can for you, but within the amount of risk that you're willing to take with your underlying investments. So there's a lot of things to be thinking about in the lead up to 30 June, but also things to be thinking about from the 1st of July going forward. And I think it's in that sort of area that it's really important when you look at the complications around all of these changes, not to underestimate the power that the advice can give to you to make sure that you are heading in the right direction. I know a lot of people are self-directed when it comes to their own self-managed superannuation fund, but when we have significant changes like this, it is always worth, I think, just taking the time to get a second opinion, to get somebody else to confirm what it is that you think you can do, what you believe the rules to be, to make sure that the decisions that you do make about your own super, because it is your own super at the end of the day, are the right decisions and is going to give you the best benefit into the longer run. Now, just to finish off, what I'd like to do is just talk to you about the BT Self-Managed Super Fund offering and some of the things that it can do to assist you when you are looking to run your own self-managed superannuation fund. Because at BT, we've created a new place to manage a self-managed superannuation fund. Whether you're, as a trustee, you're just starting out on the journey or whether you have plenty of experience. Now, at the heart of all of the BT SMSF offer is panorama investments, where you have choice in terms of the types of investments that you want to have. It becomes easy to build and manage a diversified portfolio with a broad range of investment options and also smart digital tools in terms of how you can interact. And if as a trustee you choose to, you can then access our fund establishment or administration services as well. Now, our fund establishment service option makes getting started with a self-managed super fund easy. We can help you with all the paperwork that's required to establish a fund, including setting up the trustee structure of your choice, be that individual or corporate trustees. If, as a trustee, if you aren't working with an accountant today or administrator, our self-managed super fund administration service can help keep you on track and make sure that your fund is up to date with all of its regulatory and reporting requirements, and so you have a better handle on what your actual total investment is within the superannuation environment. So in doing that, we can help reduce the paperwork and day-to-day administration. We can help support compliance and provide you with more peace of mind with the help of our self-managed super fund professionals. We'll prepare the SMSF's financial statements, we can arrange an independent annual audit, and we can also look after the fund's annual tax return. Now, with BT SMSF from an investments perspective, you get access to a world of investments all in one place, which includes a single integrated cash hub, which works like an online bank account, selection of term deposits with competitive rates, access to a broad range of ASX listed securities, as well as managed funds from a range of leading fund managers with domestic and international exposure. exposure, including access to property and infrastructure, and finally to BT's managed portfolio solutions that combine the benefits of professionally managed investments with direct ownerships of the assets within your self-managed super fund portfolio. And if you're after more information, including access to videos that highlight the BT SMSF experience, please go to bt.com.au or you can go to westpac.com.au. And on that note, I'll thank you for your time for this part of the presentation, and I'll hand you back to Lisa.
Wonderful, fantastic. Thank you very much, Brian. Certainly a wealth of information there that you can see that Brian's got. Now we'll open up to see whether or not we've got any questions. So if you've got a burning question, now's the time to type it in. So remember, on the right-hand side, you've got a questions panel that you can type it in, or if you're joining us from a mobile device, there'll be a little question mark either at the top of the screen or the bottom of the screen. So just give us a minute or so to see whether or not we've got any questions, and Brian is more than happy to answer in the time remaining.
Okay, so I will address the first question that has come through. It's a question from Nick, who asks, should pensions with balances greater than $1.6 million be reset at 30 June 2017 or at the 1st of July 2017? Now, the answer is you essentially have a choice as to when do you choose to do it. But as indicated through the course of the presentation, if you choose to do it by the 30th of June, and by the 30th of June means you could do it on that date and reset to that $1.6 million balance, then that's when you have the ability to get the CGT relief coming through. If you don't do it by 30th of June, and so you choose to do it potentially as early as the 1st of July 2017, that resetting of the cost base will no longer be an option for you. Now, when we talk about self-managed superannuation funds, and from a practical perspective, how can we do it on the 30th of June if we're needing to wait for account balances and so on to be determined and assets to be valued, so that we know we can get it down to the right $1.6 million and we know how much we need to do? Some of this, because it's talked about doing it by the time the fund lodges its tax return, there is some work that can be done post the 30th of June. But realistically, as trustees or as a member of your own fund, you need to have made the decision to reset by the 30th of June, and you would expect at the very minimum there will be some form of communication from you as a member to the trustees, so again to yourself, and a resolution by the trustees that these steps will be taken as of the 30th of June, and that resolution occurs by the 30th of June itself. It will be too late to make that resolution after the 30th of June.
So at this point in time, Brian, I'd like to say a very big thank you to you and your wealth of knowledge and being able to share it with us today. And as we say, a copy of the recording will be available on the Davidson Institute website, as well as you all receiving a link later on today. So again, thank you everybody for today, and we wish you all the best in your SMSF going forward. Thank you and good afternoon.